I was able to make 1,000% profits, turning just $6 into $69 within just 2 days using this strategy that I'm going to teach you in this video. Welcome back to Everything Options. My name is Greg, and today I'm going to be talking about the GHETTO spread. So to break this video down for you, first I'm going to talk about the basics behind the strategy and how exactly it works. Then I'm going to talk about the risks that are associated with the strategy, and finally at the end of this video, I'm going to show you a real example trade that I am actually in right now. So you'll probably want to stick around for this. But before we get into it, if you learn anything out of this video, make sure to leave a like down below. And if you've used this strategy before, comment what your experience has been. So for politically correct reasons, I'm not going to be calling this strategy by its name, but I do want to give you its origin because this did come from a YouTuber that I was literally obsessed with between about December of 2019 to about March of 2020. And this is the trading fraternity. He used to hold live trading sessions each and every day, and he still does at this point, so props to him. Thank you for your videos, Josh, and thank you for putting me onto this. This strategy got its name because it's not like any other type of spread, because usually with spreads, you just have to enter it once and then you're done for the most part until you close it, of course. But with this strategy, you actually have to pay pretty close attention to the price action. So for this reason, I'm going to be calling this the very attentive spread, or VAS. And the reason why it's so complicated is that you're actually opening the legs of your spread at totally different times. Whenever you buy an option and whenever you sell an option is going to be separate, unlike a regular spread like with a debit spread or a credit spread. So this means that you're going to be buying and selling your options separately at different times based on the price action for the stock. And the ideal way that you want to run the strategy is first start out by picking a direction. So if you think that a stock is going to go up, you're going to use call options for the strategy. It works a lot like a debit spread, but it's not quite a debit spread. And if you think that the stock is going to go down, you're going to use put options for the strategy. And the second step is to actually wait. I know it's a wild concept and patience is a virtue in this world, but you want the stock to start doing what you expected. So if you expected it to fall, wait for it to fall a little bit. And if you expected it to rise a little bit, then wait for it to rise. The amount of time and price action that you wait for is going to depend on two things. First, the amount of premium that you pay for your original option, and then second, the premium that you'll receive from selling a further out of the money option, which is the next step in the strategy. This means, for example, if a stock is going for $90 and you buy a $100 call to begin with, you're going to be selling a 101 call against that because that is further out of the money when it comes to call options. But if you think that the stock is going to go down and it's still at $90, if you think that it's going to go down all the way to $80, you would buy the 80 put and then you would sell a 79 put against it. And ideally, you would want this new short option that you're selling to be around the same price that you originally bought your first option for. So if we bought that $100 call earlier for $100 and then we were selling a 101 call against that, we want that 101 call to be roughly around $100. And if you get it exactly, then congratulations, you took on a zero risk trade. But not exactly. I wish there was actually a zero risk strategy, but of course, nothing is guaranteed in this world. And the first risk that you should consider whenever you're opening this type of trade is what if the stock never goes in the direction of your favor and you can't actually sell a new call option or a put option against your original. I would say that this is pretty rare considering that you're unlikely to ever buy at the very top or the very bottom of the market, but it can be the case, and if that is the case, that means that your long position will be the max risk that you're taking on if you never sell a call option or a put option against it. So if you put down $1,000 on your trade whenever you initiated it and you don't sell any options against those, then you're taking on $1,000 of risk, and usually these options are out of the money whenever you open them. And if those options expire out of the money, you will lose that entire $1,000 that you invested for this trade. So word of caution here, and don't put more money than you're willing to risk on your very first trade whenever you're opening this strategy. But a way that you can mitigate this risk is by selling an option for cheaper. You can sell it cheaper and it'll be more like a debit spread rather than a VAS, and this will help to reduce the risk that you're taking on. Obviously, this isn't ideal, but it can be helpful if you feel like you've taken on too much risk to begin with and your options are still going against you. If you sold $500 worth of options against your $1,000 of long options, then you're bringing down your risk to just $500, down by 50%. And if you're right about your assumption and the stock goes in your favor and above your strike prices for call options and below your strike prices for put options, then, well, you could double your money from $500 to $1,000 in this scenario. But if your options expire out of the money, this works just like any other long option, to where you will lose the entirety of what you put down for your trade. So if you have $500, you can still lose $500 if both of your options expire out of the money. But this still isn't the riskiest part of the strategy. The riskiest part is when it comes to the expiration date and the risk of being exercised on your long options. If your stock goes between your long option and your short option strike price, then you might be on the hook to either buy or sell 100 shares of your stock at the strike price for your long option that you bought. For example, if XYZ stock is trading at $100.50 at expiration and you originally bought a $100 call option and you sold a 101 call against that, the 101 call over here isn't going to be assigned to you because it expired out of the money, but the $100 call option that you bought is going to be exercised since it is in the money at expiration. This means that you have to put down $10,000 to buy 100 shares of your stock at $100. And I don't know about you, but I don't have $10,000 to put down on a single stock right now. And the great thing about the strategy, and really any other option strategy, is that you can close your options before they expire. And the way that you're going to close these is just the opposite to how you open them. So for the options that you bought, you're going to sell those. And then for the options that you sold, you're going to buy to close those. And I know this all sounds like voodoo witchcraft, but I promise you it's not that hard. Just do the opposite to how you open these spreads. And that covers the basics, the risks, so let's get into an actual example using the strategy. But before we get into the example, if you want to see what options I'm trading every day, I post all my trade alerts to my premium Discord. You can find that in my Patreon, which is going to be linked down in the pinned comment below. So the first trade that I initiated this strategy with was this TLT put option. So I'm betting on TLT going down. That is my underlying assumption. I think that TLT is going to come down between now and my expiration date of 12/17, and I'm betting on it being below $140. And for this trade, I paid $110. Then my next move was for TLT to actually move in the direction of my favor. So I had to wait this out a couple days. I opened this on 9/14, and then the put option that I sold against it was on 9/16. And this was a $139 strike price that I sold. So it's 1 point deeper out of the money, and I sold this for $108 of credit. Remember, I paid $110 for the other one. I got a 108 credit from this. So I put $2 down on this trade essentially, and I turned that $2 into $15 at this point. So I'm up by 650% for a $13 profit. So in order to make up for that dollar gain that I'm not experiencing at this point, I decided to open even more put options. A couple days later, actually I think it was the next day, I bought 2 more put options, the same $140 strike prices that I originally bought, and for these 2 I paid $240. And then I waited for TLT to come back down, and that happened, I believe, the very next day. And these TLT puts that I sold, the 139 strike prices, I sold 2 of them for $236 of credit. I paid $240 for the other ones. I sold these for $236. So all in all, with the 3 spreads that I had open at this point, I put $6 down on this trade, and I turned that $6 into $69 for a 1,050% profit, which is really impressive. But again, it's not a high dollar amount. So what did I do next? Well, I bought even more put options, and I bought this one for $140. And looking back on it, this is a little bit expensive compared to where TLT is sitting now and where these put options are going for. But I decided to average down on this today by buying another one for $115, and finally another one for $104 right here. So I have 3 excess long put options on TLT at this point, and I want to sell 3 more put options at the 139 strike price against this. And ideally, I want these options to be around the same price that I pay for the excess long options, and the average cost for these right now is around $120 at this point. So what I want is for the 139 put options to go for around the same price. It doesn't have to be exact, but right now they're going for $89. So they have to gain $30 in order for me to, think about selling more of these put options and bringing down my risk. But I could do this even if these put options don't go in the direction of my favor. I could sell them now for $90 and I would turn my $350 of risk or so into, $80 of risk, and then my max profit for this trade would be as much as $600, which is the difference between the two strike prices, 140 and 139, times 100 shares that you're controlling, and then we would have 6 spreads open at this point. So we would turn that $80 into $600 if I'm correct about TLT being below $139 by my expiration date of 12/17. But if it's not, and I don't open any new TLT 139 put options, if I don't sell to open these new options, then I'm risking $357. So I'm having $357 down on the table, and I'm willing to lose that at the moment if I'm wrong about this trade. Right now, I think that TLT is probably going to go in the direction of my favor over the next few days, over the next few weeks or so. So I'm going to wait for TLT to drop. That way I can sell these options for around the same price that I bought the 3 excess TLT 140 puts. But that is just my assumption based on my own research. So do with that what you will. And with that said, thanks for making it all the way to the end of the video. And thank you to all my patrons for the support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.